President of Blue Line Futures with us now. Bill, great to have you with us. And I do want to start with, with the underpinning of so much uncertainty on the economic side, what you're thinking about the S&P 500 and valuations of these markets today.
I mean, with yields as low as they are, I don't think the market is overvalued. In fact, I think generally speaking, I would expect new record highs probably before the end of the year, because I do expect Washington to bring fiscal policy and get a coronavirus aid bill out there. And it's going to be a tailwind after the election. Now we could see piece by piece before the election. We could see, which I do think is a little unlikely, we could see a watered down bill that's then topped up after the election. But overall, I mean, the market is showing you what it will do when this bill gets passed. So I think, I'm prepared to see stock market higher. Again, with yields as low as they are, I don't see it being overvalued.
We definitely, as you note, are seeing resistance points, both for the S&P 500, also for tech-heavy NASDAQ. What do you make of those resistance points? We saw this market hit and then back off a pretty big resistance point right around these high levels. If it should break through it, what's on the other side of that?
Well, 34.31 is a big retracement level. There's definitely been some volume traded there, and that happens to be right around the high here today. And we're holding up pretty well against it, so it's not getting a rejection. For the tech side, about 11,550 has been a big area that we failed at last week, and we're testing again here today. So I'm less concerned about these resistance levels and the fact that it keeps knocking on the door. And the more that it knocks on the door, we're going to see it break through. So we had the sell-off on Tuesday with following the tweet from President Trump, and the market just roared right back. I think that's bullish. And again, the reason why the dips are being so steadfastly bought is because not only is the Fed accommodative and promising to keep rates lower through August 2023, but we're expecting fiscal policy, and that kind of ties into my outlook into Q4, where the Washington Congress are going to get together and they're going to get this done, but they're going to print debt. I mean, this is going to be supported by more and more debt and new Treasury auctions, and that is ultimately going to add to the supply of Treasuries, and that's going to weigh on the Treasury market. You know what happens when the Treasury market goes down? That means inversely yields are rising. So one of my bigger plays is actually to look for yields rising in the Q4 coming out after the election.
Yeah, that's an interesting one. I want to pop up the 10-year Treasury here, because we're seeing there's a lot of speculation here that we may get another bull run, a little move for Treasuries. You're saying the opposite. You're going to see yields go back up. What are you looking for when it comes to yields?
Well, I mean, it's a very, very crowded trade, and I want to say, that I have always been a trader, at least for the last 3 to 5 years, of buy the dips in the Treasury market and steadfastly ride this thing higher. I'm calling it an intermission. I'm not calling a top in the Treasury market, but I do think the 10-year prices, we're going to see those down 134. We could see as low as 132. Now, that would sort of align with the August 2016 high in Treasuries before they broke out coming into this year, and really, that's about 1.3%. So I'm not talking about a regime shift in the fact of where the Treasury yields are going. I'm talking about just kind of coming off this bottom a little bit, because it's too crowded down here. We've seen the market try to test lower, and it hasn't really been able to sustain anything below 50 basis points. So we need to now go test the upper band. But then you have some fundamentals behind it. After QE1, QE2, and QE3, we saw the Treasury market top and yields bottom out because the Treasury market rallied and yields were suppressed on the anticipation of stimulus. What have we had this year? Massive amounts of stimulus that's going to create inflation. And we already have started to see inflation, 1.6% in PCE. We're coming off the floor. It's getting closer and closer to the Fed's 2.0%. And don't think for a second, you're not going to hear the Fed talk about where they're going to hike rates. Now, it's not going to be 2021, but they could start moving the timeline up to 2022, and that's going to further support yields. Now, I don't think yields stay higher for longer, but I think that's definitely something you cannot ignore. And then on top of that, when we get through elections, 2008, 2012, and 2016, we've seen the Treasury market top after elections because all those politicians are now not posturing to their base. They are getting deals done in Washington, and they're printing money to support the economy. So I think that's exactly what we're going to see here after November. So my big trade for Q4 is positioning short in the 10-year Treasury market, doing it in a number of ways.
All right, that's a good tip. And let's talk about your view on crude oil here, because we're seeing a lot of pressure on it on the global demand side. The fundamentals not so great at the moment. What's your thinking on crude?
Well, yeah, you said it. We're not seeing great fundamentals. We're seeing the restrictions, lockdowns potentially getting worse as the outbreaks tick up here. And the fear of a second wave is coming upon us. But guess what? The market is not going lower. And one of the reasons why it's going higher is the anticipation of fiscal policy. We've seen what stimulus can do when coming out of the pandemic. We've seen what stimulus can do over the last several years and buoy a market. And ultimately, we're starting to see that with crude oil. But I don't think we're giving OPEC enough credit fundamentally for what they've been able to do. One of my rhetorics more recently was the fact that we saw the harsh comments from the Saudi oil minister a few weeks back because he was fearing that we're going to see more production come back online. But he was sort of right. I mean, and we were right in calling that. But the market itself went lower 2 weeks ago, and it's battled back. And instead, we've seen really great technical groundwork. 36.5 is a huge support level, double bottom there. And now the market's moving higher. Yeah, sometimes it needs a little bit of another tailwind. The Hurricane Delta has helped lift the market up a little bit. But it's not just a hurricane. And really what it is this is a great technical market. OPEC's done a tremendous job throughout the year. And overall, there's a little bit better demand than people may think because they look back a few weeks ago, IEA as well as OPEC, they brought down those demand expectations for 2021. But if we get more stimulus, then those demand expectations could be a little bit better, especially if there's a vaccine. Those demand expectations could be a little bit better. So all of this is working. Now you got the technicals, too. The 50-day moving average is crossing out above the 200-day moving average. Get the golden cross, bring you a technical tailwind, and then a trend line from the beginning of this year. We break out above. So I'm bullish crude oil. I'm positioning today. Started buying the 43, 47 call spreads for about 90 cents. And then as well, there's a couple ways you can do it. We do something called a ladder call spread, one of our trading programs. We did 44, 47, and then sold the 49.50 above that. So there's a couple ways you can position long, define your risk in the market, and try and ride this wave.
Well, then I want to get you to gold here, because that's another one that feels like a bit of a trader's market at the moment. What are you seeing in gold by way of opportunity?
You said it. It's a trader's market. I mean, we've had tremendous support down at 1850. That was actually our buy area. We put recommendations out, overall over and over again for the last couple of months. Look for 1855 to be a buyer, but we also like buying in front of that 1900 area. So we like having an average position in gold, average price around 1875, 1880, and when we know we're wrong is when it starts closing on a weekly basis below 1790. And I don't think that's really going to happen, but I think you need to look at gold the long term. I mean, from a futures trading perspective, I like being long in the futures, and the CME, the exchange has given different contract sizes. You can really customize how you want to be in this contract. There's 10-ounce contracts, there's 50-ounce contracts, there's 33-ounce contracts, there's 100-ounce contracts. So you can own the pure play. I think that's really one of the best ways to play gold. Is that pure commodity play. I think 2,300 in the first quarter, but we're not going to break out. Remember, I said Treasury yields are going to rise. That's going to hold gold back in the Q4. We're also going to see it's in a seasonally soft time of year. Gold has also not really performed during elections too much. So, I think there's a seasonal trade now after all this. December 23rd, you buy gold, but you hold it through January. Last 14 out of the last 16 years, it's made money. So I'm looking at the end of December through Q1. Gold, that's what's going to break out to 2,300, and that's what I'm building that position for. And in our portfolios, I'm not even rebalancing where gold is. We've held gold in the portfolios, and yeah, we use a couple ETFs that we use easily to track for clients that are not doing the futures with us. And I'm not even rebalancing that. I like holding that larger position in gold right now. That started the year between a 6 and 10% pocket of the portfolio, now to almost up to 15 or 17% pocket of the portfolio. If it gets any much higher, though, after that quarter breakout, we'll start to rebalance it a bit.
Oh, Bill, that's awesome content and advice. Appreciate it. Bill Baruch, president of Blue Line Futures, and some very specific advice there.